Thanks, Jeff. And now it's time to bring in our next guest, income and tax specialist David McAdams, president of McAdams Group, a retirement income store located just outside of Memphis, Tennessee. So, Dave, you've got this Clark Kent look going here, which I guess is actually fitting because, after all, I know you are Superman in the eyes of a lot of your clients.
Yeah, that's, I guess some of them feel that way, and especially my children feel that way. But I'm going to take the Superman compliment. I like that. I'll stick with that. Thanks.
Sounds good.
Well, Dave, your clients expect you to be the Superman of tax savings. So what are some of the most common questions or concerns you hear from your clients about their taxes?
Common questions or concerns. Right now, we're talking to our clients a lot about legislative risk. A lot of them are seemingly terrified about what tax law changes are coming down the pike, especially when it comes to capital gains tax, things that can traditionally disincentivize investors and savers and really hurt people during retirement. When you're trying to get income from those buckets, how do you get them out tax efficiently? So I'd say legislative risk. And we get a lot of questions about, should I do a Roth conversion, a Roth IRA conversion? Those are probably the two biggest things we hear from clients.
Yeah, we hear those a lot down here too, but there's also a lot of common mistakes that your clients and my clients and Dave's clients make with their taxes. So are there any other savings opportunities that you utilize that folks are missing?
Well, your show is the income generation. So a lot of your retired income generating clients are making a common mistake when they go to take their required distributions out of their IRAs. They often fail to understand something called qualified charitable distributions, or QCDs. And, in many cases, people have already determined that they're going to give some money to charity. They're not itemizing their taxes or taking a standard deduction. And by having the IRA custodian write the check directly to the church or charitable group that they want to give to, they can effectively take that amount right off the tax return. It's immediate tax savings, and it also goes towards the amount that they have to take out for required distributions. So I think that's a common mistake. And I would say, going back to the Roth IRA discussion, right now taxes are on sale. So you could make an argument, depending on your bracket and depending on a number of variables, there might be a small window of time where Roth IRA conversions could be beneficial for a lot of retirees.
It's funny, Dave. I've been in your office in February, March, beginning of April, and it's a zoo. I mean, everybody's jumping in, trying to get their taxes done and so on. But that's not the best time for your clients to actually do tax planning, correct?
Yeah. So as far as tax planning goes, often if you start in January or February and you start planning for that tax year, you can often implement tax saving strategies that would reduce your taxes more so than if you wait till the last minute to do that. So you don't really want to wait till November or December to try to do your tax savings. You want to start earlier in the year. There's a number of things people can be doing now to try to increase their tax savings for the year. For example, if they're not already doing it, you should be maxing out your 401ks. If you're eligible for a health savings account, you should explore that. You should consider subsidizing a dependent care FSA if your employer offers it. And finally, you should do some tax capturing. Try to sell those dogs, try to get some capital losses on the books so you can offset capital gains. Those are some of the things that you can be planning for in advance as opposed to waiting till last minute.
Great words of wisdom there, Mr. McAdams, aka Clark Kent, because unfortunately many think tax planning is January, February for the previous year, and you and I both know it's too late by then. So thanks so much again for being a friend of the income generation.
Thanks for having me.